For more on all this, let's bring in Lori Calvasina, RBC's head of U.S. equity strategy. Lori, great to have you with us. I mean, everybody's watching this, but when it comes to the market's performance, even over the next 6 months, how important is this?
Well, thanks for having me, as always, Melissa. Look, I think that this is a huge issue right now. As I've talked to investors over the last month or so, some of the more bearish people we've talked to have been very focused on the debt ceiling as a potential trigger to see a short-term drawdown in the U.S. equity market. And frankly, a lot of those investors are coming from outside of the U.S. They are people who are inclined to be negative on the U.S. for other reasons as well. But I do think that if we can get a deal here, it is going to remove an important issue that the bears have really been pointing to in coming months that could pull this market down.
How do you view where those drawdowns might be from, Lori? I mean, is tech because it's seen the biggest gains? Is that the area, or is tech because it's defensive? Will that be safe, relatively speaking?
So it's a great question, Melissa, and the answer is it's a little bit of both. We actually went back and we've mapped out the equity market response to every single drawdown around the debt ceiling going back to 2011. And when we looked at sector performance within the S&P during those drawdown periods, we found that the worst performing areas were the value-oriented sectors, financials, energy, materials, and industrials. The defensive sectors obviously held up the best, though healthcare was the worst performing defensive, and tech and the growth sectors were right smack dab in the middle. So I do think that tech gets hurt, but it probably holds up better than some of those more cyclically oriented areas if we don't get a deal.
So, Lori, we haven't really seen the market come in at all. It didn't come in on earnings. And I think what kind of masked it was earnings were bad at the back half of 2022, but energy sort of masked that. Now, when we're looking at the debt ceiling negotiations, the market has not stuttered or taken a step back. So when we eventually see this deal, A, do you think the deal is going to be done in the 11th hour? Because it doesn't behoove either side to get a deal done before the 30th of May. And B, where does the market rip to, if it does rip at all, or do you think that's totally factored in?
So, look, I think that's a bunch of great questions. And I would say last year, we do think the equity market essentially priced in a recession at those October lows, really pre-traded 2023 back in 2022. And I think one of the reasons why the market hasn't drawn down that much is that the markets understand that this has happened before. Now, when I talk to non-U.S. based investors, they're very worried about the debt ceiling. When you talk to U.S. based investors, they're feeling increasingly worse about it, but they're like, okay, you know, a deal generally does get done. So I think people in the States have been holding their breath, understanding how this political theater tends to play out. And so what we've seen is really more rotation than pulling money out of the market because of that latter group of investors thinking something will get done at the 11th hour. I think what's been interesting to me about this debt ceiling issue is that it's just been another excuse for investors to rotate into tech and growth stocks and pull money out of cyclicals. We pre-traded the Fed pause at the beginning of the year. It triggered that rotation. Then we had SVB. Then we had these great tech earnings. And this is like the fourth thing we've had that's pushed people into tech stocks because of a rotation argument. So I think it's fascinating. I will say in terms of, kind of potential upside from here, we're at 4,100 on the S&P as our year-end target. We still like that number. We do think valuations are about where they deserve to be. But I'll be honest with you, I have some models that could take us up to 4,200, that could take us up to 4,300. So we have said we see more upside risk than downside risk to the market this year. That being said, we've got to get through this debt ceiling issue. I mean, this is really a significant hurdle we've got to get through. I am optimistic because the two sides are finally talking, but I do think it makes sense that people have been waiting and holding their breath to see what happens.